Silver closed the week at 84.47. Gold closed at 51.71. Gold had a great ending of the week. It pumped from 50.50 to 51.70, over $100. Solid move. But silver could not even get above 85. It tried. Multiple times. Every single time it got to 85, it got slapped back down. Gold is moving and silver is stuck. And that is not normal. That is not how silver is supposed to behave in a precious metals rally. And I think I know why it is happening. There is something going on at the $85 level in silver that I need to walk you through, because once you see it, you cannot unsee it. Welcome to the hidden economy. If you are new here, hit subscribe and hit the hype button. I dig into the data that mainstream finance ignores, and I am going to show you a pattern in gold that has repeated 5 or 6 times during this entire bull market. A pattern that tells you exactly where gold is headed next. And when you combine that with what is happening to silver right now, it paints a picture that is both terrifying and exciting at the same time. Stay until the end, because the gold pattern is the key to understanding everything. Let me start with what is happening to silver at 85. Because this is the most important technical setup in the silver market right now. $85 used to be support. Go back a few weeks, silver was trading above 85. 85 was the floor. Every time silver pulled back, it would touch 85 and bounce. Buyers would step in. The level held. Then Monday happened. Silver crashed from 96 to 77. It blew right through 85 on the way down like it was not even there. And here is the rule that every trader learns the hard way. When a support level breaks, it becomes resistance. The floor becomes the ceiling. 85 was holding silver up. Now it is holding silver down. Look at the daily candle chart this week. Silver tried to get above 85 on Tuesday. Rejected. Tried again on Wednesday. Rejected. Thursday, same thing. Every attempt to break 85 has been met with selling. Heavy selling. And the fact that silver closed the week at 84.47, just below 85, tells you the sellers are parked right at that level and they are not moving. And here is what I find really telling. The daily candle on Thursday had a wick that poked above 85 and then got hammered back below it by the close. That is what we call a rejection wick. The market tried to break through, got above the level intraday, and then got pushed right back below it before the day ended. 1 rejection you can ignore. 2 rejections you pay attention to. 3 or 4 rejections in the same week at the same level. That is not random. That is somebody actively defending that level. Somebody with enough capital to absorb every buy order that tries to push silver through 85 and push it right back down. In my experience, when you see a level get defended this aggressively for this many consecutive sessions, one of 2 things happens. Either the level holds and price eventually gives up and moves lower as buyers exhaust themselves, or the selling at the level runs out of ammunition and the breakout that follows is explosive because all the failed attempts created pent-up buying pressure that releases at once. Given what I am seeing in the broader data, and I will show you that data in a minute, I think we are heading for the explosive breakout scenario. But the timing depends on gold, and I will explain why in a moment. Now, here is what makes this more concerning. This is not just a technical level anymore. There is something structural happening. Silver is not pumping on its own. Let me explain what I mean by that. Earlier in this bull market, silver would have days where it just took off. Gold would be flat or slightly up, and silver would rip 2 or 3% on its own. It had independent momentum. Buyers were coming into silver specifically. The industrial demand narrative, the supply deficit story, the solar panel thesis, all of that was driving independent buying in silver. That is not happening right now. Right now, silver only moves when gold moves. Gold goes up, silver follows. Gold goes flat, silver goes flat. Gold goes down, silver goes down harder. Silver has lost its independent bid. It is trading purely as a derivative of gold with a leverage multiplier. And that tells me something important about who is in control of the silver market right now. When silver has independent momentum, it means real buyers are driving the price, physical buyers, industrial buyers, retail stackers, people who want the metal. When silver loses that independence and only follows gold tick for tick, it means the paper market is in full control. The algorithms, the funds, the big players who trade silver futures as a leveraged gold bet. And those players are the ones who benefit from capping silver at 85. Think about it. From their perspective, if you're a large fund that is short silver or a bank that wants to accumulate physical at lower prices, the $85 level is your best friend right now. You know every retail trader in the world is watching 85 because it was the old support. You know that if silver breaks above 85, the narrative changes from bearish to bullish and buying pressure accelerates. So you defend 85. You sell into every rally at that level. You make sure the breakout does not happen. And every time silver gets rejected at 85, a few more retail traders give up and sell their positions. That is how the transfer works. Cap the price, frustrate the holders, wait for them to sell, accumulate their metal, then let the cap go and the price moves. I've seen this pattern play out dozens of times across my years watching this market. A level gets defended aggressively, retail gets shaken out, the big players accumulate, and then one day the level breaks, and the move that follows is violent because all the selling pressure that was keeping the cap in place disappears at once, and there is nothing above it. Now let me connect this to what is happening in the COMEX, because this is where the $85 cap gets really interesting. COMEX silver open interest has collapsed 60%. Let me say that again, 60%. The total number of outstanding silver futures contracts on the COMEX has been cut by more than half. We are at levels not seen since the 2013 bottom. 2013. That was the absolute low point of the last precious metals bear market. Silver was under $15 back then. And the open interest is at the same level now, with silver at 84. That is a massive divergence. What does that mean? It means the liquidity in the silver futures market has dried up. There are fewer contracts being traded, fewer players at the table, and when liquidity dries up, the market becomes easier to manipulate. It takes less money to move the price. It takes fewer contracts to cap a level like 85. In a liquid market with high open interest, defending a price level is expensive because there are a lot of buyers pushing against you. In a market where open interest has collapsed 60%, defending 85 is cheap. You need a fraction of the capital to hold the line. This is why I think the $85 cap is so effective right now. The market has been drained of liquidity. The speculative longs who were driving silver higher have been wiped out by the Monday crash. Their margin calls liquidated their positions. And what is left is a thin market where a relatively small amount of selling can keep the price below a key level. That is not conspiracy. That is market structure. When liquidity collapses, the remaining players with the most capital have the most control. And in the COMEX silver market, the players with the most capital are the banks. And here is the part that should worry anyone who is short silver right now. The SHFE in Shanghai has 8 million ounces of silver left. 8 million? I have been covering the vault drains for weeks, and this number gets worse every time I check it. The Shanghai Futures Exchange is running on fumes. COMEX is down to 350 million ounces from 530 million. The Shanghai Gold Exchange has collapsed from 39 million to 14 million. And the SHFE is at 8 million. The question I keep asking myself is what happens when one of these exchanges simply does not have enough metal to fulfill a delivery? What happens when a contract holder says, I want my silver, and the exchange says, we do not have it? That is called a default. And a default on a major exchange would reprice silver overnight in a way that no cap at 85 or any other level could contain. Now let me zoom out to gold, because there's a pattern happening in this bull market that I think is the most important chart pattern nobody's talking about. And it directly affects where silver goes next. Gold has been moving up in 20% chunks. Not slowly, not gradually, in bursts. Go look at the gold chart over the past few years and you will see it. Gold moves up about 20% in a matter of weeks. Then it stops, consolidates, trades sideways for a few months. Everyone gets bored, everyone says the rally is over, and then it does it again. Another 20%, another burst, another consolidation. There have been 5 or 6 of these breakouts on the chart, and here is what makes the pattern so powerful. Each 20% move is calculated from a higher base. The first 20% move was from, say, 1,000 to 1,200. The next was from 1,200 to 1,400. Then 1,600 to 2,000. Then 2,000 to 2,400. Then 3,000 to 3,600. Then 4,200 to 5,000. Each time the dollar amount of the move gets bigger, because 20% of a bigger number is a bigger number. That is how gold went from 1,000 to 5,000 in about 10 years. Not in a straight line, in chunks. 20% at a time. And right now, in my view, we are in another consolidation. Gold topped around 5,600. It crashed. It has been trading sideways and volatile for weeks. That looks exactly like every other consolidation that came before the next 20% move. The pattern is the same. The structure is the same. The psychology is the same. Everyone is saying the rally is over. Everyone is pointing at the crash. Everyone is scared. That is exactly what happened at every previous consolidation before the next burst. Now do the math. 20% above the 5,100 area where gold is sitting right now would take gold above 6,000. That is the next target, if the pattern repeats. And the pattern has repeated 5 or 6 times already. I'm not saying it definitely will, but the track record of this pattern during this bull market is 100%. Every single consolidation was followed by another 20% move up. Everyone. And here is where it connects to silver. If gold makes that next 20% move to 6,000, silver does not go up 20%. Silver goes up 40 or 50%, because silver amplifies gold moves. That is what leverage does. A 20% gold move could turn into a 50% silver move. And if silver is sitting at 84 right now, 50% higher is 126, above the all-time high. That is the math. If the gold pattern repeats and silver amplifies the way it always does, the all-time high in silver gets taken out on the next move. But here's the catch. Silver has to break 85 first, and right now it cannot. So you have this bizarre situation where the long-term setup is incredibly bullish, but the short-term price action is completely capped. The spring is being compressed, but the cap is holding it down. And the longer the cap holds while the fundamentals build underneath, the more violent the eventual breakout becomes. Now, I want to explain something that I think changes how you look at the gold price entirely, because most people have it backwards. Gold is not going up. The dollar is going down. I know that sounds like the same thing, but it is not. When you see gold go from 1,000 to 2,000 to 5,000 over 10 years, your brain tells you gold is getting more expensive. But that is an illusion created by the measuring stick. The measuring stick is the dollar, and the dollar is losing purchasing power every single year. Inflation, money printing, debt expansion, all of it erodes the value of each dollar. So when gold goes from 1,000 to 5,000, it is not that gold became 5 times more valuable. It is that the dollar became 5 times less valuable. Gold is the mirror. It is reflecting the destruction of the currency back at you. And when you think about it that way, the idea that gold could go back to 2,000 or 3,000 stops making sense. Because for gold to go back to those levels, the dollar would have to gain purchasing power. The debt would have to shrink. The money supply would have to contract. Inflation would have to reverse. None of that is happening. Now, the debt is growing by $1 trillion every 100 days. The Fed is stuck between inflation and recession. And the war is making everything worse. The dollar is not getting stronger in real terms. It is getting weaker. It is losing purchasing power against everything that is real. Food, energy, housing, and gold. So when someone tells you gold is in a bubble, ask them this. Is the dollar in a bubble? Because gold is just the inverse. If the dollar keeps devaluing, and all the data says it will, then gold keeps going up. Not because of speculation. Not because of hype. Because of math. The math of a currency that is being debased by its own government at a rate of $1 trillion every 100 days. This is the lens I use for every single analysis I do on this channel. I do not ask, is gold going up? I ask, is the dollar going down? And when you flip the question like that, the answer becomes obvious. Of course, the dollar is going down. It has been going down for 50 years. It has lost over 90% of its purchasing power since 1971, when Nixon took us off the gold standard. The only question is how fast it goes down from here. And the answer right now is faster than at any point since the 70s. War plus tariffs, plus debt, plus a paralyzed Fed equals accelerated dollar depreciation. And accelerated dollar depreciation equals accelerated gold and silver appreciation. That is not a trade. That is math. And this is where I want to talk about what I think is coming for interest rates, because this part is going to make the gold and silver bull case even stronger. I believe we are heading toward a period of negative real interest rates. What that means is the rate of inflation will be higher than the interest rate the Fed sets. The Fed might have rates at 3.5%. But if inflation is running at 5 or 6% because of the war and oil and tariffs, the real rate is negative. You are losing money by holding cash in a bank account. Your savings are shrinking in real terms every month. That is stagflation. Stagnant growth plus inflation. And stagflation is the single most bullish environment for precious metals that exists. In the 1970s, stagflation sent gold from $35 to $850. That is a 24 times increase. We are entering a similar environment. War driving oil prices, tariffs driving import prices, Fed unable to cut because inflation is sticky, economy slowing because consumers are squeezed, that is stagflation. And gold and silver thrive in it because they are the only assets that protect purchasing power when both the economy and the currency are deteriorating at the same time. I have been thinking about this a lot this week. The war with Iran has now entered its second week. The Strait of Hormuz is still down 70%. 15% global tariffs just started. And the Fed pushed rate cuts to September at the earliest. All of those things together create the exact conditions for negative real rates. The Fed is at 350 to 375. But oil at these levels, plus tariffs, plus supply chain disruptions from the war, could push inflation to 5 or 6% by summer. If that happens, and I think it is more likely than not at this point, real rates go deeply negative. And deeply negative real rates are the single strongest fundamental driver for gold that exists in economics. It has been true for 50 years. When real rates are negative, gold outperforms every other asset class. Period. That is not my opinion. That is what the historical data shows across every decade since 1971. And silver, in a negative real rate environment, does not just keep pace with gold. It outperforms gold by multiples. because silver has both the monetary premium that comes with negative real rates and the industrial demand that stays constant regardless of rates. Double engine, both firing at the same time. This is why I keep saying the daily price action does not matter as much as people think it does. Silver is being capped at 85 today. Gold is consolidating after its crash. The charts look messy. The volatility is insane. But the macro environment underneath is the most bullish setup for precious metals in 50 years. Negative real rates coming, dollar devaluing, central banks buying gold at record pace, silver vaults collapsing across 3 exchanges, and gold has a proven pattern of moving 20% at a time, with the next move targeting 6,000. The short term is noise. The cap at 85 is noise. The COMEX liquidity collapse is noise for now, but it is building pressure that will eventually release. What matters is the direction, and the direction is clear. The dollar is losing purchasing power. Gold is going up in chunks. Silver is being compressed, and compressed things eventually explode. Now let me talk about what I think the manipulation actually looks like in practice, because I want you to understand the mechanics, not just the theory. The big funds and banks use the charts against retail traders. Here's how. They know where the stops are. They know where the support levels are. They know where retail traders have their buy and sell orders clustered. And they use that knowledge to trigger those orders in the direction that benefits them. They push the price down to trigger stop losses. The stop losses create automatic selling. The automatic selling pushes the price down more. More stops get triggered. More selling. It cascades. And the funds that push the initial move are on the other side, buying everything that retail is forced to sell. That is how you transfer physical metal from weak hands to strong hands. You use the chart structure that retail traders rely on as a weapon against them. This is why, in an environment like this, trading silver futures is a losing game for retail. The house has the data. The house has the capital. The house knows where your stops are. You're playing poker against someone who can see your cards. The only way to win that game is to not play it. Own the physical metal. Do not trade the paper. When you own physical silver or gold, nobody can stop loss you out of your position. Nobody can margin call you. Nobody can use the chart against you. You just hold the metal and wait for the macro environment to do what the macro environment is going to do. And here is why I feel so strongly about this point right now specifically. The COMEX open interest is at 2013 levels. The vaults are draining. The liquidity is gone. That means the paper market is a shell of what it used to be. The price you see on your screen for silver is being set in a market that has lost 60% of its participants. That is like checking the price of a house in a neighborhood where 60% of the buyers have left. The price you see is not the real price. It is the price that the remaining few participants have agreed on among themselves. And those remaining participants are overwhelmingly banks and large funds. Not retail, not physical buyers, banks. The physical market is telling a completely different story. Premiums are elevated. Delivery demand is surging. Vaults are draining. The Shanghai price is still at a premium over COMEX. All of that says the real price of silver, the price where actual physical metal changes hands, is higher than what the COMEX screen shows. And that gap between the paper price and the physical reality is going to close. It always does. The question is whether it closes by the physical price coming down or the paper price going up. And with 8 million ounces left on the SHFE and COMEX down 34%, I think we all know which direction that gap closes. And what the macro environment is going to do based on everything I have shown you today is devalue the dollar further and send gold and silver higher. The question is just timing and whether you have the patience to sit through the noise while the fundamentals do their work. I want to say something personal before I wrap up. I sat with these charts all week, every day watching silver try to break 85 and get rejected, and every day watching the vault numbers get worse, and every day watching gold hold its ground after that Monday crash. And what hit me this week, more than any other week, is that we are watching 2 completely different markets at the same time. The paper market says silver is worth $84. The physical market says there is barely any silver left in the vaults. Both of those things cannot be true at the same time forever. One of them is lying. And I have never in my career seen the gap between what the paper says and what the physical says be this wide. Something is going to break. I do not know if it breaks next week or next month. But when it breaks, the people who understood this gap are the ones who will be positioned correctly. And the people who only watch the paper price will wonder what happened. That is what keeps me doing this every single day, making sure you see both sides of the market, not just the one they want you to see. Drop a comment. Tell me if you think 85 breaks next week or if the cap holds. Tell me if you think gold makes the next 20% move or consolidates longer. I want to hear your analysis. I will pin the best ones. Share this video. The COMEX liquidity data and the gold 20% pattern are things that most retail investors have never seen broken down this way. Help me reach them before they make a decision based on a chart that is being used against them. If you are new here, hit subscribe. I cover COMEX data, vault reports, dollar mechanics, and the manipulation patterns that drive gold and silver prices. Nobody else is putting this data together the way I do on this channel. Links in the description. This is the hidden economy. Silver capped at 85. COMEX liquidity down 60%. Shanghai running on 8 million ounces. Gold moving in 20% chunks with 6,000 next. The dollar is not getting stronger. It is measuring its own destruction. And the cap on silver is not going to hold forever. Follow the data, not the noise.